Welcome back everyone and Happy New Year. This is a brief update on the oil market. This week's oil outlook provides new information coming from all over the world that could seemingly reverse the oil market's selling sentiment and could be hinting the start of a new period with major changes. Starting with the OPEC Plus group, notable action has been taken that indicates the oil producers team is looking to turn things around as we enter the first quarter of 2019. According to Reuters, OPEC oil supply dropped in December by the biggest volume in almost 2 years and is the largest month-on-month decline since January 2017. Starting with the most significant producer in OPEC, Saudi Arabia enacted the largest supply cut of the group, totaling 400,000 barrels per day. We must take a note of the kingdom's intentions to intensify production cuts during January by carrying out a larger cut than required under the OPEC Plus deal. The second biggest supply cut, quite surprisingly, came from the United Arab Emirates. The source noted that both the Saudi Kingdom and the United Arab Emirates had willingly cut production supply. On the contrary, and also surprisingly, Iraq increased its output and sent 295,000 barrels per day to the United States, increasing by 140,000 barrels per day compared to November. Furthermore, shipments from Venezuela also increased by approximately 23,000 barrels per day. In total, it is estimated that OPEC pumped 32.68 million barrels in December, reducing its output by 460,000 barrels per day compared to the previous month. Moreover, while OPEC is confirmed to cut production in January, market participants could be interested in further output declines in order to form a mid to long-term opinion in oil price direction. Then again, global slowdown worries could also be affecting OPEC and its decisions, and so caution could remain in focus. Regarding the US, some decrease in oil imports appetite was confirmed in December. Oil cargoes sent from OPEC nations to the United States dropped to 1.63 million barrels per day during the past month, down from 1.8 million barrels per day in November. Analysts cited the growing US shale production and the increasing excess supply in the US as the reason for a decreased demand for imported crude. We go even further on the matter and stress worries that the OPEC Plus group may not be cutting enough production needed to counter the ever-increasing oil driller activity in the United States. This may force OPEC to take further action if prices do not return to desirable levels. Yesterday, a survey released by the Federal Reserve Bank of Dallas may have shed vital information for the future months regarding the US oil market. A survey of executive sentiment showed a drop to -10 from 47 in the previous quarter, the first negative reading since early 2016, while the executives are using a price of $50 to $64.99 per barrel for future arrangements. Another interesting outcome was the service firms, which handle drilling in the oil fields, had a more bearish outlook than exploration and production firms. Approximately 60% of service firms stated greater uncertainty, and more than half of executives said they expect decreased capital spending in 2019. For more information and trading ideas, you can visit our webpage, follow us on Twitter, like us on Facebook, or subscribe to our YouTube channel. This is Angelo Zittis from IronFX wishing you solid trading.